You didn't click on this video to hear about another small price pump, another fake rumor, or another XRP to the moon tomorrow headline. You clicked because deep down you feel that something much bigger is happening, something that most people are completely missing. And today I want to show you exactly what that is. Welcome back to the channel. We are Cosmic. If you are new here, this channel is not about hype. It's not about emotional trading. Here, we break down crypto and finance like professionals using logic, data, and real institutional signals. So make sure you subscribe, because what we're talking about today is not short-term noise. It's a long-term structural shift. Right now, most retail traders are glued to charts. They're watching 5-minute candles, RSI levels, and daily price swings. But while the crowd is staring at the surface, the real work is happening underneath. The actual architecture of the global financial system is being quietly rewritten. This is what I call the invisible plumbing. The pipes that move trillions of dollars every single day are being replaced, and almost nobody is paying attention to the indicators that truly matter. This is not about speculation anymore. This is about infrastructure. Today, the global banking system moves roughly $5 trillion per day through the legacy SWIFT network, and it still takes 3 to 5 days for final settlement. That's slow, expensive, and inefficient. Banks know this, governments know this, institutions know this. Now compare that to the XRP Ledger. The XRPL can settle value in 3 seconds at a fraction of the cost with no need for pre-funded accounts. That efficiency gap is not small, it's massive, and that gap is exactly why we are now seeing institutions move past experiments and pilots and into real deployment. For years, critics said XRP was just a bridge. They said banks would buy it, use it for a few seconds, and dump it immediately. According to that logic, XRP would never hold long-term value. That narrative is officially dead. What's happening now is something very different. We are watching XRP transform from a transactional asset into a treasury asset. Not just something you pass through, but something you hold. Behind the scenes, major institutional players are building professional-grade tools that allow XRP to sit on balance sheets, earn yield, and function as a core treasury asset. This is the part of the story you won't see in price charts. Partnerships like Evernorth and Doppler Finance are not about marketing. They are about building vaults, not bridges. Vaults where capital lives, works, and grows. When institutions start holding XRP instead of just using it, the entire supply-demand equation changes. And when a company already holding over $1 billion in XRP begins building infrastructure for other institutions to do the same, you are no longer in a retail-driven market. You are entering an institutional one. This is the birth of institutional DeFi, regulated, structured, and built for banks, not degens. A world where corporate treasuries don't let trillions sit idle, losing value to inflation, but instead deploy capital directly on ledger to earn low-risk yield. And here's the key point most people don't understand. When banks move from being users to being holders, price is no longer driven by hype. It's driven by necessity. The plumbing is almost finished. And once the water starts flowing, the financial landscape will never look the same again. To truly understand what is happening with XRP, we need to stop looking at price charts and start looking at people. Not influencers, not anonymous developers, but real decision makers, the kind of people who move billions, not millions. Because this shift is not being driven by retail demand. It is being driven from the top down. At the center of this transformation is Ashish Birla, a former Ripple executive who now leads Evernorth. This is a critical detail. When experienced insiders leave Ripple and immediately begin building infrastructure around the XRP Ledger, that tells us something very important. They are not guessing. They already know how the system is designed to scale. Evernorth is not a startup chasing hype. It is a purpose-built digital asset treasury company, and it has already accumulated over $1 billion worth of XRP. Let that number sink in for a moment. That single treasury alone represents roughly 1% of XRP's circulating supply. Many global banks have a lower market capitalization than that. This is not a passive investment. This XRP is positioned as deep liquidity for institutional settlement and treasury operations, and this is only the beginning. Ashish Birla has openly stated that this billion-dollar position is just the baseline. The long-term vision is far bigger. The plan is to take Evernorth public on the NASDAQ under the ticker XRPN. If this happens, it creates create something the market has never seen before, a regulated, publicly traded gateway into XRP's utility. This matters because traditional institutions cannot simply buy tokens on an exchange. They need structure. They need compliance. They need audited vehicles that fit inside existing legal frameworks. A NASDAQ-listed XRP Treasury solves that problem instantly. Now enter Doppler Finance. This partnership is not about speculation. Doppler provides the technical engine, while Evernorth provides the capital. Together, they are building the missing layer that has kept banks on the sidelines for over a decade, a professional-grade framework for deploying XRP liquidity on-chain. Banks don't fear volatility as much as they fear uncertainty. They need predictable systems, controlled risk, and clear rules. This partnership directly addresses that need. For the first time, a multi-billion-dollar bank can enter the XRP ecosystem without worrying about experimental DeFi risk, unclear custody, or unstable yield mechanisms. This is the professionalization of the ledger in real time. And the timing is not accidental. With backing from SBI Holdings, one of Japan's largest financial institutions, this initiative gains serious geopolitical weight. SBI has already committed hundreds of millions of dollars to XRP-focused infrastructure. Japan is not experimenting, Japan is executing. What we are witnessing is coordination. Former Ripple leadership, Japanese megabanks, specialized financial infrastructure firms. This is how global systems are built. Quietly, deliberately, and long before retail notices. While most of the market is distracted by short-term volatility, the real story is happening in contracts, treasury strategies, and institutional balance sheets. This is not about a quick pump. This is about replacing legacy systems that can no longer handle the speed and scale of modern finance. When institutions begin integrating XRP not just as a payment rail, but as a core treasury asset, the game changes. Supply starts getting locked. Liquidity becomes strategic, and price discovery moves from emotion to mathematics. This is why I keep saying the window is closing, not because XRP will moon tomorrow, but because utility-driven accumulation is already underway. And once institutions fully commit, they don't chase price, they set it. For nearly a decade, the conversation around XRP has always been the same. It's a bridge asset. Banks could send dollars from New York to yen in Tokyo in 3 seconds using XRP as a pass-through token. Efficient, fast, and technically impressive. But in reality, it created a velocity problem. If institutions only held XRP for a few seconds, there was no long-term demand. Price didn't matter. Supply didn't matter. Everything was temporary. That's why critics argued XRP couldn't sustain value. But the narrative is changing completely. Now, we are entering the era of Treasury XRP. Instead of using XRP only for transactions, institutions are starting to hold it, not for speculation, but for yield generation, liquidity management, and strategic balance sheet deployment. This changes everything. Let's break down why this matters. Evernorth and Doppler Finance are building the first professional-grade vaults for XRP. These vaults allow banks to park XRP and earn a regulated low-risk return. No more temporary transfers, no more buy and sell in seconds. Now, XRP can sit on a corporate treasury and work for the institution. Think of it like this. Traditional corporate treasuries hold over $3 trillion in idle cash, losing value every year due to inflation. If just 1% of that idle capital shifts to the XRP ledger, we're talking about $30 billion of fresh institutional liquidity flowing into the ecosystem. That's not hype, that's math. And it gets even more sophisticated. The upcoming XRP Ledger Lending Protocol, XLS66, allows institutions to lend XRP and earn fixed-term, fixed-rate yield. Unlike traditional DeFi, where risk is pooled and exposure is shared, XLS66 isolates every loan into single-asset vaults, ensuring that a default in one vault doesn't affect the rest. This is huge. It means banks can treat XRP like cash equivalents on a balance sheet, safe, predictable, and yield-bearing. A bank can now replace idle fiat with XRP, earn 4 to 7% on-chain, and maintain liquidity for corporate operations. This is what I call XRP-Fi, the decentralization of the corporate treasury. Every token isn't just moving money anymore, it's part of the global financial infrastructure. Each token provides utility, liquidity, and a return for its holder. Now consider the supply-demand impact. When institutions start holding XRP instead of selling it immediately after a transaction, circulating supply drops, high velocity is replaced by long-term accumulation. Every vault, every treasury, every institutional wallet becomes a demand anchor in the market. We're not talking about retail FOMO. We're talking about structural adoption. This is how a currency evolves into a commodity, a digital gold of the 21st century. Scarce, productive, and deeply integrated into the financial system. The shift is already visible in recent partnerships. Evernorth's billion-dollar treasury is not idle. It's being deployed to provide liquidity to other institutions, creating a network effect that strengthens XRP's fundamental value. Add to that the upcoming NASDAQ listing under XRPN, and you have a regulated gateway for institutional capital. This is a huge signal. It means even conservative investors can gain exposure to XRP's utility without leaving the legal frameworks of traditional finance. The story is clear. XRP is no longer just a bridge. It is becoming a core institutional asset, designed to sit on balance sheets, generate yield, and serve as the backbone of next-generation finance. In the next part, we will break down the technical upgrades. Version 3.0.0, XLS66, dilithium quantum security, and explain how they make XRP safe, scalable, and ready for trillions of dollars in institutional adoption. So far, we've talked about the people, the partnerships, and the shift from bridge to treasury. But there's another critical piece of this puzzle, the technology itself. Without it, none of this institutional adoption would be possible. In late 2025, the XRP Ledger underwent its most significant upgrade yet, version 3.0.0. For casual traders, this might sound like a simple software update, but for banks and regulators, this was a signal of maturity. The developers didn't focus on flashy retail features. They focused on fortifying the ledger. Every decimal, every transaction, every edge case was addressed to ensure that billions of dollars can move safely and reliably. One major improvement was the introduction of fixed token escrow v1. This ensures that multi-purpose tokens now account for every transaction perfectly. No more rounding errors, no inconsistencies, and no surprises. They also added the stint32 data type, allowing the ledger to handle native integers. This may sound technical, but it's critical for professional risk calculations, lending scripts, and treasury operations. Banks live and die by numbers, and the ledger now speaks their language. The team also addressed scalability. Many critics point to XRP's 1,500 transactions per second, TPS, and compare it to Visa or Ethereum. But here's the hidden truth. XRP isn't competing with retail networks. It's designed for wholesale banking, where one transaction can represent tens of millions of dollars. Compared to Swift, which averages 500 messages per second, the XRP Ledger is already triple the capacity needed. But the upgrade goes further. Developers are preparing for horizontal scaling, a network of networks approach. Sidechains and EVM-compatible layers allow banks to run private chains for high-frequency internal operations, while settling net balances on the XRP mainnet. This design ensures infinite throughput without compromising the ledger's integrity. The mainnet remains fast and secure, while sidechains handle billions of smaller transactions. This is how you make XRP ready for the $320 trillion global financial system. Security was another priority. Version 3.0.0 implements quantum-resistant signatures using the dilithium algorithm. Why does this matter? Banks don't just care about today, they care about decades. Quantum computers, even if years away, could retroactively decrypt transactions today. Dilithium provides a permanent defensive wall, ensuring that every transaction remains secure for 50+ years. This quantum-safe approach is huge. It demonstrates that Ripple is thinking like a central bank, not a startup. For institutions, this is a prerequisite, not a luxury. Other improvements include enhanced APIs for simulation and dry run testing. This means banks can test complex transactions before committing, reducing costly errors, and ensuring predictable outcomes. Now that we've covered the people and the technology, it's time to talk about how XRP actually works as a treasury asset, how banks and institutions will earn yield, manage liquidity, and turn idle capital into productive assets. The key innovation here is the XRP Ledger Lending Protocol, XLS66. Unlike traditional DeFi platforms, which pool everyone's assets together and expose participants to shared risk, XLS66 uses single asset vaults. This means every institution's deposit and loan is isolated, reducing the risk of defaults affecting other participants. For banks, this is critical. They don't tolerate systemic risk the way retail users might on other blockchains. XLS66 gives them predictable, secure, and regulated exposure. Here's how it works in practice. A bank can deposit XRP into a vault, which is then used to provide liquidity to other institutions or financial products. The bank earns a fixed-term, fixed-rate yield, just like corporate bonds or commercial paper. The difference? It's all native on-chain, fully auditable, and cleared in seconds. This fundamentally changes the supply-demand dynamics. Previously, XRP was high velocity, moving through the system in seconds, then sold back into fiat. Now, XRP can sit in vaults for days, weeks, or months, generating yield. That reduces circulating supply and creates long-term scarcity pressure. To put it into perspective, corporate treasuries currently hold trillions in idle cash, which loses value to inflation. If even a fraction of that, say 1%, flows into XRP vaults, we're talking about tens of billions in new utility-driven demand, and that is before retail or speculative flows are even considered. Another important point is compliance and predictability. XLS66 integrates KYC and AML processes off-chain, then records the loan on the ledger. Repayments and interest are automatically managed by the protocol. No manual reconciliation, no surprises. This level of predictability is exactly what banks need to adopt crypto as a treasury tool. The protocol also allows professional market makers to borrow XRP for liquidity management and fintech providers to borrow stablecoins for instant payouts. Every transaction creates real economic utility, separate from speculation. This is what turns XRP from a payment token into a productive asset. We're now entering the era of XRP Fi, the decentralization of corporate treasuries. Every token held in these vaults becomes part of a global liquidity network. It earns yield, supports corporate operations, and reduces reliance on inefficient legacy systems. This is the hidden driver behind the upcoming institutional adoption. While retail traders watch charts and candles, banks are focused on efficiency, yield, and security. Once a few large institutions fully adopt this system, it will set the standard for the entire market. Combine this with Evernorth's billion-dollar XRP treasury, Doppler Finance's technical infrastructure, and the NASDAQ XRPN listing, and you have a complete ecosystem for institutional capital deployment. This is no longer a test. This is production-ready global finance integration. Finally, consider the long-term effects. With vaults locking XRP and yield-generating mechanisms in place, the market begins to price XRP based on utility and treasury demand, not hype or short-term speculation. This represents a fundamental shift in valuation methodology. Now we arrive at the final part of this breakdown, the big picture. We've talked about the people, the technology, and the treasury mechanics. But all of this only matters if the world actually adopts it. And that's exactly what's happening. Japan is leading the way. Over the last decade, SBI Holdings has quietly built the XRP ecosystem into the core of Japan's financial infrastructure. Today, over 60 Japanese banks, representing nearly 8% of the country's total banking assets, are part of the SBI Ripple Asia Consortium. This is not a pilot program. This is full-scale integration. Japanese banks are using the XRP Ledger for domestic and international settlement, replacing legacy systems that were slow, costly, and inefficient. Transactions that used to take days now settle in 3 seconds, 24/7, without the need for pre-funded accounts. This is the proof that XRP works at scale. When an entire nation's banking system begins to adopt a blockchain, it is no longer theoretical. It is real-world finance. And it's not just Japan. We're seeing early signs of cross-border institutional coordination. Former Ripple executives, Evernorth, Doppler Finance, and other financial infrastructure providers are building a global framework. This network allows trillions in liquidity to move securely, efficiently, and auditable on-chain. The implications for holders are profound. When banks and corporations start holding XRP long-term, circulating supply decreases. The market begins to price XRP based on utility and institutional demand, not speculation. This is a structural supply shock that cannot be ignored. The combination of treasury adoption, lending protocols, institutional-grade infrastructure, and quantum-safe security creates an environment where XRP is no longer just a cryptocurrency, it becomes digital capital, an asset that generates yield for institutions, supports global settlements, reduces reliance on inefficient legacy systems, provides a secure, auditable, and long-term store of value. This is why I call it the XRP revolution. We are witnessing a shift in the foundation of global finance. XRP is moving from being a fast payment token to becoming the core infrastructure of corporate treasuries worldwide. Institutions are no longer testing it, they are investing in it, building on it, and planning for decades of use. For individual holders, the takeaway is clear. This is a long-term story. Retail hype may still drive short-term price movements, but the real driver of value will be adoption by banks, corporations, and national financial systems. If you followed this 6-part breakdown, here's what you should remember. The people behind XRP matter. Evernorth, Doppler, SBI, and former Ripple executives are positioning the ledger for global finance. The technology is ready. Version 3.0.0, XLS66. Dilithium security and horizontal scaling provide a professional-grade platform. The Treasury mechanics work. XLS66 allows banks to hold XRP, earn yield, and deploy liquidity in a regulated environment. Global adoption is real. Japan is already operating an XRP-first banking model, and cross-border frameworks are emerging. Supply-demand dynamics are shifting. Institutions locking XRP reduce circulating supply, creating a structural foundation for long-term value. In short, we are not looking at another speculative coin. We are looking at the birth of a new financial infrastructure, one that could redefine how global capital moves and grows. For long-term XRP holders, the future isn't just hope for price pumps. The future is utility, adoption, and institutional demand. And that is a story that will unfold over years, not months. But when it does, it will change everything. This is the invisible plumbing of global finance. And now, thanks to Evernorth, Doppler, SBI, and the XRP Ledger, it's finally coming into view. Stay informed, stay patient, and remember, the revolution is structural, not speculative.